In this week's video, we'll use hard data and charts to explore 5 widely held beliefs about the current stock market rally, with the objective of trying to discern between a legitimate concern and a showstopper for the stock market rally. Widely held belief number 1, an elevated VIX means the rally's in trouble. It's a daily chart of the original volatility index, VXO. It's dated July 23rd of 2020. We just experienced an extremely rare spike in the volatility index. Now it's come down, and we just experienced the 7th daily close below the 200-day moving average. Hot off the presses on July 23rd. Thus, it might be helpful to know, in the history of the original volatility index, how many times have we seen a massive spike like this and then a 7th consecutive close below the 200-day? The answer is only 2 times. Why are we using the old VIX? Because we have data going back all the way to 1986, and you can see we're looking at all the data. Something similar has only occurred 2 previous times in the last 34 years, 2008, 2009, and in the wake of the 1987 crash. Here's the look in 2020. Here's the extremely rare spike that occurred during the 1987 crash, and then the 7th daily close below the 200-day moving average occurred on February 24th of 1988. 2008-2009 case, the extremely rare spike in the volatility index, the 7th consecutive close below the 200-day moving average occurred on April 14th of 2009. Since this is extremely rare, and it's only happened 2 previous times in the last 34 years, it might be helpful to ask and answer. How did stocks perform walking forward in the 2 previous cases? The answer is extremely well. Average gain 1 year later, 27%. Average gain 2 years later, almost 40%. 3 years later, over 50%. 4 years later, over 70%. And 5 years later, just a hair over 90%. Thus, something that just occurred this week, something measurable, aligns with a common theme that we've covered in recent weeks. As long as the data allows, we can try to maintain a longer-term focus. Historically, if you wanted to get to the right side of this table, it was extremely important to have realistic expectations about 100% normal and to be expected volatility. It wasn't necessarily a cakewalk over the next 6 months. How about maximum drawdowns in the historical cases? It's very, very easy to look at a 5% drawdown over the weekend and say, not a big deal. Real time, a 5% drawdown is extremely painful. Average drawdown in the 2 historical cases, just over 3%. Therefore, if we're willing to make decisions based on the right side of this table, it's extremely important to understand what this type of drawdown would look like in the present day. And here's the answer. Wouldn't be shocking if the S&P 500 moved back to 3,200, 3,135, or all the way back to 3,069. To get to the right side of the table in the historical cases, you had to withstand similar drawdowns. Widely held belief number 2, everyone is bullish. It's very, very difficult to say that everyone is bullish or everyone is all in the present day when we have stats like this. Bespoke Investment Group, tweet on your screen. Here's the Twitter handle. American Association of Individual Investors, bearish sentiment has exceeded bullish sentiment for a record-tying 22 consecutive weeks. If everybody was all in, would it really make sense for them to answer that they're bearish? Why would you be all in if you expected the stock market to be down 6 months from today? Sentiment speaks to cash on the sidelines. Tweet says that July 23rd, something that just happened this week, hot off the presses, is similar to December 28th of 1990. And we all know that sentiment readings can be helpful at extremes. I would say that this represents an extreme. Ties the all-time record. Therefore, it might be helpful to ask and answer. How did stocks perform after the only other period of prolonged bearish sentiment? So let's put December 28th, 1990 on a chart. Lower left-hand corner of your screen is December 28th, 1990, and see how the stock market performed. Not surprisingly, with extremely rare and prolonged bearish sentiment, the market performed well. In fact, it performed extremely well, tacking on 365% between December 28th of 1990 and the peak in the spring of the year 2000. Once again, it's very, very easy to watch this video and focus on this number and totally ignore this drawdown here. Once again, it wasn't a cakewalk in the short term. In this case, the market experienced a 5.18% drawdown over the next 12 calendar days. There's no free lunch in the stock market. To get out here, you had to withstand a pretty significant drawdown. I can assure you in the present day, if the market falls 5%, it will not feel good, and it did not feel good in 1991. It never feels good. And there's always things to be concerned about, always, when the market falls 5%. Markets don't fall 5% for no reason. Thus, in order to keep realistic expectations, it might be helpful to know what a 5% drawdown would look like hypothetically in the present day. The answer is we could fall all the way to 3067 and we would still be on track relative to the previous historical case from 1990. Widely held belief number 3, momentum has stalled. At the opening of the video, we said we were covering legitimate concerns. These are legitimate concerns. And it probably is fair to say that short-term momentum has stalled a bit. That's a fact. Market really hasn't gone anywhere since June 8th. However, short-term momentum speaks to shorter-term odds, and longer-term momentum speaks to longer-term odds. Our time frame is longer term. As you can see on the chart here, it's relatively rare for momentum, which is what the stochastic oscillator measures, to be this weak and then to become this strong. You can make an argument this is really somewhat of a thrust here, a momentum thrust. A thrust, a thrust, a thrust. There's no opinions here on the screen. We can measure this here, and we can measure this here, and we can go back and find out how many times it's happened dating back to 2009. And we can ask ourselves, how did the stock market perform? How many times has it happened previously? 1, 2, 3, 4, 5. How did the stock market perform? If you had realistic expectations and you were patient, very, very well over the next 6 months to 2 years. 100% of the cases higher 6 months later. 100% of the cases higher 1 year later, and all of the cases higher 2 years later. Average gain 1 year later, 16.45%. Average gain 2 years later, over 40%. Once again, something that just happened recently aligns with the longer-term focus as long as the data allows. And it also aligns with keeping realistic expectations about volatility and pullbacks. As we've said several times, it would be great if the stock market went up every day or every week. It just doesn't work that way. And in the real world, if you wanted to get out to the right side of the table, you had to accept some pretty painful drawdowns. Average drawdown 2.69%, largest 4.57%. Thus, if we're going to accept the right side of the table and accept this study, then we also have to have realistic expectations, because if we followed a similar path, we could fall all the way back to 3075 or any one of the lines shown on the screen here. It's important to note that all of the drawdown charts that we've been covering in these videos in recent weeks and months help us with the concept of it being difficult sometimes to see the forest for the trees. Another way to phrase that is, sometimes it's difficult to see the forest because of the trees. A tree can be thought of as a drawdown. The forest is the bigger picture. We just experienced some unnerving volatility this week. Here's a hypothetical drawdown chart that we covered back in June, and we covered it in last week's video. Last week, we basically said we don't really see anything on this chart here that's particularly concerning relative to historical precedent. Therefore, to help us answer this question again this week, it would be helpful to look at this chart, dated July 16th, during the session on Friday, July 24th. This is the tree right here. This is the 40-point drop where my cursor is that occurred on Thursday of this week. This is the 22-point drop that's occurring intraday as of 9:32 a.m. on Friday, July 24th. This is a tree. This is a tree. This is the forest. It's very, very difficult to look at this chart and look at this tree and this tree and say thus far that we've seen significant damage to the forest hypothesis. How about the momentum thrust study that we performed several weeks ago? We covered this chart last week. Once again, this one is dated July 16th. How does the exact same chart look on July 24th? Same exact concepts. Here's a tree. This is the 40-point drop. We're down 20 points when this chart was printed on Friday, July 24th. This is a tree. This is a tree. This is the forest. Having realistic expectations helps us combat a common problem for all of us. Recency bias. It's very, very easy when the market's falling 40 points right here to forget about everything that we've covered since April of this year. Why? Emotions are in play. A lot of red on the screen. It doesn't feel good. There's nothing magical about these drawdown charts. Like everything else we do, they simply help us assess probabilities. If the current drawdown takes us into this area here, it tells us something about increasing bearish probabilities. If the current drawdown moves into this area here, it tells us something about increasing bearish probabilities. We could go back and look at this VIX study from June. It's a bullish study. It tells us to keep an open mind about much better than expected outcomes looking out 1 to 5 years. Once again, if we want to embrace the bullish part of this study that was conducted in June, we also have to embrace the historical drawdowns from that study. These lines tell us the market could fall all the way down into these areas here, and we really wouldn't have done anything to violate the study that we covered in June. Like every chart that we cover, this chart doesn't predict anything. It just helps us assess and helps us rationally answer this question and helps us rationally look at a tree or two trees within the context of the forest. Widely held belief number 4. It's a very narrow rally. Only tech and growth stocks are rallying in 2020. It's very, very difficult to make the argument that this is a narrow rally. The small cap Russell 2000 index is made up of, you guessed it, 2,000 stocks. I only have data for IWM going back to the year 2000, so we're looking at all of the data. Looking at the 85 session rate of change. Why 85 sessions? It's been 85 sessions since the stock market bottomed in March of this year. An index made up of 2,000 stocks experienced one of its strongest rallies in history in 2002-2003. It experienced one of its strongest rallies in history in late 08, 09, and we just experienced one of the strongest rallies in history 2 previous times dating back to the year 2000. Nowhere else can you find where you hit this lower line and then you make it back to the upper line. These are the only 3 cases. Once again, this is something that just happened. Hitting the upper line occurred on July 17th of 2020. How did the S&P 500 perform walking forward from this date here and this date here, both of which are similar to July 17th of 2020? The answer is the market, S&P 500, performed extremely well. Average gains 6 months later, 16.95%. 1 year later, still double digits. 2 years later, 33%. 3 years later, almost 36%. And 4 years later, 64.31%. Once again, it's easy to watch a video like this and assume that the stock market goes up every day. To capture these returns in both historical cases, you had to withstand, this is a gut-wrenching drawdown. I can assure you, if we fall over 4% in the present day, it will feel awful. It will feel like every single bullish analysis that we've covered in recent weeks and months is 100% inaccurate. History says we could fall all the way back to the blue line, the green line, or the red line, and we still wouldn't be doing anything out of character with the 2 previous historical cases. Historically, in order to get out here and capture these returns, it wasn't necessarily a picnic over the next 9 calendar days to 22 calendar days. Said another way, wouldn't be shocking in the present day, even if really good things happen over the next 6 months to 4 years, to see some really bad things happen in the short run. Another widely held belief in 2020, it's an extremely narrow rally. The whole rally is based on 5 stocks. The facts just do not support that narrative. The value line geometric index is about as broad and fair as you can get relative to looking at market breadth. Tracks over 1,600 stocks. Dating back to 1982, we just experienced one of the broadest and strongest rallies in stock market history. Let me repeat that. We just experienced one of the broadest and strongest stock market rallies in history. That's a fact. You can see it right here. The 17-week rate of change. Why 17 weeks? It's been 17 weeks since the low. We've only seen a move like this 2 previous times in the last 38 years. And it's not a coincidence, in terms of probabilities, that they both occurred after major lows. Hitting this blue line here is similar to July 2nd of 2009 and December 12th of 1982. Now, if you know your market history, you know July 2nd of 2009 and December 12th of 1982 represent the early stages of 2 of the best periods in our lifetime to own stocks. This point is similar to the present day. This point is similar to the present day. There's no other point dating back to 1982 that's similar to these 3 points. And in the 2 previous cases, good things happen for a really long period of time. This table looks out 6 months to 10 years in the S&P 500. Table's all green. It means the stock market has to go up on Monday, Tuesday, Wednesday of next week. It has to go up, or else this analysis is wrong. Well, it didn't go up in the 2 previous cases. There was a painful drawdown relatively quickly in both cases. Over the next 5 calendar days, 3% drop. Over the next 8 calendar days, a 1.93% drop. The average drop, 2.52%. Therefore, to get out here historically, this is the type of drawdown that you would have had to have experienced in the present day, maybe all the way back to 3120. This type of table makes it seem like it's all butterflies and rainbows. Even if, emphasis on if, good things happen, it's not necessarily going to be easy in the short to intermediate term. That is a common theme that we've covered over and over again in recent weeks and months, along with the common theme that the data says that we can try to maintain a longer-term focus as long as the data supports that hypothesis. How long will that be the case? We have absolutely positively no idea. That's why we perform these studies every single week. I think it's probably fair to say that normal volatility is the number one enemy in terms of capturing long-term returns. One of the best ways to combat that issue or problem is to have realistic expectations about what can happen even under very favorable circumstances. Why are we looking at these issues from this perspective? Does history say they are necessarily showstoppers for stocks? Because the weight of the evidence that we've covered for weeks and months now is bullish. So if these issues are showstoppers, then they contradict the weight of the evidence. If they're not showstoppers, then they don't necessarily contradict the weight of the evidence. This is a trend chart that we covered in last week's video. It's dated July 16th. Here's the same chart after Thursday's sell-off. It's very, very difficult to look at this chart and say it aligns with show-stopping issues in the present day. And just as this chart, dated July 23rd, speaks to bullish outcomes from a probability perspective, a probability is quite a bit different than a certainty. But this speaks to bullish probabilities, and it aligns with the weight of the evidence that we've been covering in these videos since April of this year. We've been covering bullish evidence for over 100 calendar days now. And if the weight of the evidence starts to change in a meaningful way, then it will start to contradict our bullish hypothesis. That may happen, but it hasn't happened yet. The model uses a weight of the evidence approach, and we've used a weight of the evidence approach in these weekly videos. And we know the only way any of this works, the only way we can determine if there's a meaningful shift in the weight of the evidence, is if we head into next week and every week with a flexible, unbiased, and open mind about a wide range of outcomes, from wildly bullish to wildly bearish. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.